Hey everyone, welcome back to Corporate Decoder, where we break down the financial jargon and give you the honest truth. Today we're diving into Wintergreen Acquisition, Corp's latest report, and let me tell you there's a lot to unpack, especially when it comes to their offerings and how they manage their money to potentially find a business to buy. This is essentially a quarterly checkup on the company's financial health. Wintergreen is a blank check company, meaning it was created to buy another company. They went public in May of 2025, and the report covers their performance up to June 30th of that same year. Let's jump right into the numbers. On the asset side, they had about $1.4 million in cash as of June 30, 2025. But the really interesting part is the marketable securities held in their trust account, which stood at a hefty $56.3 million. This is the money they raised from investors specifically to buy another business. Now notice this line item, ordinary shares subject to possible redemption. This means that a large chunk of the shares they sold can be bought back from the investors. As of June 30th, they had over 5.5 million shares like this, valued at almost $49 million. This is important because it represents money that might have to be paid back to shareholders if a deal doesn't happen. On the operations side, for the 3 months ending June 30th, Wintergreen reported a net income of about $113,000. It sounds good, but it's important to understand where this came from. A big chunk of that income, $23,000 to be exact, came from the interest earned on their investments in that trust account. This isn't from actual business operations, but from the money they're holding on to. They also had over $84,000 in operating expenses for that quarter. Looking at earnings per share, the non-redeemable shares had a loss of 12 cents. This is typical for a company that's still looking for a business to acquire. They're spending money but not generating revenue from operations yet. For the first 6 months of the year combined, their net income was about $38,000 with similar sources of income as the quarterly report. The total operating expenses for the 6 months were around $160,000. Now let's look at how they used their cash. For the 6 months ending June 30th, they used about $148,000 in operating activities. This is the money spent on running the company even before finding a target business. They also used over $56 million for purchasing investments for their trust account. This is the core of their business right now, investing the IPO proceeds. Where did the money come from? Well, financing activities provided about $57 million, primarily from the sale of their public units in the IPO. This was the main way they raised capital to fund their operations and investments. Let's delve a bit deeper into what this company is all about. Wintergreen Acquisition Corp was formed in April of 2024. It's essentially a shell company created with the sole purpose of finding and merging with another business. They had no operations and no revenue as of this report. Their efforts were focused entirely on getting ready for this IPO, which happened in May of 2025. The main backer or sponsor of this company is a group called Macro Dream Holdings Limited. They invested in the company to get it started. Their big event was the initial public offering or IPO on May 30, 2025. They sold 5 million units at $10 each, raising a cool $50 million before costs. They also had an additional option for underwriters to buy more units, and they exercised part of that option. Right alongside the IPO, they had a private placement where their sponsor bought another 253,875 units for about $2.5 million. This is common practice to give the key investors a stake. A crucial detail here is that the money raised in the IPO, the $56 million plus in the trust account, is locked up. It can't be used by the company until they successfully complete a business combination or if they have to give it back to investors. This section is a bit technical, but it outlines the rules they follow to prepare their financial statements. They are an emerging growth company, which means they have some flexibility in reporting rules. This can make it a bit tricky to compare their numbers directly to other, more established companies. They use fair value for some of their assets and liabilities. This means they estimate what something is worth at a specific point in time rather than just its original cost. For things like the over-allotment option, which is a liability, they have to use complex methods to figure out its fair value. This is a really important part for investors in these types of companies because so many shares are redeemable, meaning investors can ask for their money back. The company has to account for this potential outflow of cash. They essentially treat these redeemable shares separately, almost like a debt, because there's a strong possibility they'll have to pay them back. This line shows they are actively adjusting the value of these redeemable shares. They added over $500,000 to the value of these shares. This is essentially an increase in the amount they might owe back to shareholders. This section just reiterates the details of their IPO, 5 million units at $10 each, raising $50 million, plus that partial exercise of the underwriter's option, bringing in almost another $6 million. They also pay significant fees to the underwriters. In this case, about 4% of the IPO proceeds was paid out as underwriting commissions, both in cash and in shares. That's a lot of money to pay just to get the offering done. Here we see transactions with their sponsor like that 1.4 million founder shares purchased for a small amount. They also had a loan from the sponsor for working capital, which was repaid, and they pay a monthly fee for administrative support services. As a blank check company so early in its journey, everything is basically treated as one single operating segment. Their CEO, the chief decision maker, looks at the company as a whole. This is where management explains their situation. They reiterate that they have no revenues and are focused on finding a business combination. They expect costs to increase now that they are a public company. They directly state their net income came from investment earnings and a small loss on an over-allotment liability plus operating expenses. It's crucial to remember this isn't profit from doing business, but from managing the money they raised. They have enough cash for their operations for at least a year, but this all hinges on successfully finding and completing a business combination. If they don't find a target by their deadline, which is August 2026 or extendable to May 2027, they'll have to liquidate and return the money in the trust account to investors. This is a standard disclosure. They are essentially saying that if they don't find a business to buy within their time frame, there's a real concern about their ability to continue as a going concern. Investors essentially bet on the management team to find a good deal, and if they fail, the company might cease to exist. This section confirms that their management believes their internal controls over financial reporting are effective. This is important for investor confidence, ensuring that the numbers reported are reliable. Finally, we see the list of exhibits, including certifications from their CEO and CFO confirming the accuracy of the report. These are the people signing off that everything presented is truthful and compliant with regulations. So what's my take on Wintergreen Acquisition Corp? This is a classic SPAC, a special purpose acquisition company. Their entire existence and value hinge on management's ability to find and execute a deal. Right now they have cash in the bank and are earning a small amount on those funds. The biggest risk is not finding a suitable business to merge with before their deadline. If they fail, the money goes back to investors and the company effectively dissolves. Their strengths lie in the cash they've raised and the clear mandate they have. The weakness is the inherent uncertainty of the SPAC model itself. It's all about the future deal. There are no real operations to analyze yet, just potential. They are heavily reliant on their sponsor and management team to deliver a successful acquisition. A reasonable conclusion is that this is a speculative investment driven entirely by the execution of their business combination strategy. In SPAC mandate they have, the weakness is the inherent uncertainty of the SPAC model itself. It's all about the future deal. There are no real operations to analyze yet, just potential. They are heavily reliant on their sponsor and management team to deliver. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.